Let's get to our next guest. She says that while the market has been fairly resilient alongside more hawkish rhetoric so far, the level of the 10-year could become a deciding factor in where the market goes from here, at least in the near term. For more, let's bring in Ann Sonders. Ann, you just heard from Stephen. You know, it sounded to me like this should be more of a plot twist than it actually is playing out in the markets. They've, as you have said as well, been very resilient.
It has, but at the index level, there's been a lot of churn under the surface and rotation and leadership shifts. And I think that reflects some of this uncertainty as it relates to Fed policy. Obviously, the economy has been resilient in the face of the market expectations going from 6 or 7 cuts starting in March at the beginning of the year to now maybe even less than 3 cuts and not starting until mid-year. But because of economic resilience, you saw that leadership shift toward the traditional cyclicals, energy and materials, to some degree, industrials, financials. And I think that's where you get a better sense of what the market is doing and what it says about the macro environment, the Fed environment, and uncertainty there. But, we're still playing these gymnastics around, when will they start, how many cuts? And it's just a silly exercise at this point because it's going to be a function of the data. And every week brings another set of data points that could move that needle.
Yeah, Ann, you called the FOMC, I think you were joking here, the Federal Open Mouth Committee, because we've had so many comments over the last few weeks. Is it too much?
Well, it adds to the uncertainty. We're not in the Greenspan era where his voice was the only one that had the microphone, that had the megaphone, and it is the way it is at this point. There are times where they're very aligned, and you don't get a lot of volatility associated with Fed speakers. This doesn't happen to be one of those moments, and it wouldn't surprise me if at the point we get some sort of action on the part of the Fed that you might not have everybody on the same page. So, let's assume the next move is a cut. It wouldn't surprise me if there was maybe a dissent or two at that point.
Okay. Steve, this all raises the stakes for CPI and PPI.
I just want to comment on that last comment, which is I take a little bit more comfort that there's more disagreement. Kind of bugs me when everybody's on the same page, makes me think that perhaps the committee is victim of its own kind of groupthink. And I think Ann would agree. There are differences on the outlook in the market, and those should be reflected, I think, on the Fed. So, first of all, you asked the question, is it too much Fed speak? When we get to a point where the market is dramatically mispricing the Fed ahead of a meeting, then I think there's too much cacophony. But we're not there yet. The market shows incredible intelligence, incredible ability to discern. I think we'll be talking for a long time why the market, after one of the Fed meetings, started pricing 6 rate cuts.
Right.
I didn't hear that, and I thought that was wrong on the part of the market. But the onus always goes on the Fed and their own communication. If the market got it wrong, then somehow the Fed got their communication wrong.
Well, we're looking to the speakers, but then we're also looking at the data, right? So which one is kind of having conflicting signals? Is it how they're interpreting it?
It's together. It's the data and their interpretation of the data that you have to do. That's why we presented this nuance analysis there, which is that data into what? Into the brains and the minds and the outlooks of the Fed folks, and then out with policy.
Right. So then when it comes to that data, Ann, we're looking to CPI and PPI this week. If you were in the camp that you want to see a rate cut sooner rather than later, what do you need to see? Is sticky okay as long as inflation isn't reaccelerating?
No, I don't think sticky is okay, at least not in terms of a green light for the Fed to cut. I agree with Steve. I mean, the market was way over its skis. And it actually wasn't because the Fed wasn't providing the right information. I think they were, and they were pushing back on the notion of a pivot as soon as March with 6 or 7 rate cuts. That just didn't make any sense based on the data. And what I find interesting is the parlor game of will it be June, will it be July, how many, is often not expressed with because, and then fill in the blank, because we'll see a rolling over again in CPI or PPI or PCE or, core services X housing. I think it's a function of the data. The Fed did express some hope, at least, maybe confidence, that the recent uptick, especially in things like the 3-month annualized change, had a lot of seasonal components to it. But this is sort of the test case because we're past the point where you can continue to blame seasonal. So if you don't see a rolling over in inflation, I think that is very supportive of the Fed staying in pause mode, and I wouldn't be surprised if you heard some of that rhetoric.